Alright, so I'm going to go over some charts. These are panel charts where you can look at multiple markets at the same time. Wyckoff actually used something similar, but he used it for comparative strength. And on this chart, I've developed an indicator which is very, in my opinion, is very critical, because when Wyckoff he gave his instructions, it was anticipated everybody would be hand charting. Now, hand charting has, even though it's nobody does it, when it is done, you develop a very strong intuition, like a really, really strong intuition, to the point where you're able to detect the change in the supply and demand, because you're plotting the exact volume for every bar, and over time you develop a sensitivity to changes in volume, changes in the ranges of prices, the position of the close, trend, reversals, etc. Because of hand charting, you develop a profound sensitivity to the market, and then develop from that intuition. Now, that's not done nowadays, but there is something else that is done. And the closest thing I can think of, because no one's going to draw the price of the volume on the chart, everyone's looking at indicators. So what we do is we use lines. That's how we're interacting with charts, at least in today's more quote-unquote modern world, right? We draw lines, and by doing this you will develop a different type of sensitivity, but it's more around the edges. Alright? So it's very important to draw on the chart and label the chart. Labeling the behavior on the chart, because you go from observation, which is just looking at a chart, which you don't really learn anything from, by the way. A lot of people for 10 years they're looking at the chart. You're not really learning. What must be done is interaction with the chart, meaning you have to be doing something, not just observing. So how that's done is by drawing lines and labeling behavior on the chart. So that's really, really, really important. Don't just watch it, interact with it. I think Evans also, or some of them, they talked about the importance of this point. They used to draw triangles and things like that. So that's the first point. Second point is, because traders are not really hand charting, they don't get that price and volume sensitivity. So the indicators there needs to be some way of identifying or getting that feel of the change in supply and demand. So I developed this indicator where I'm identifying the volume as high and identifying that this is the highest volume in X number of bars. So for example, here on the dollar index, you had the highest volume in 10 bars. Okay? It says HV, and underneath that it says 10B. That's the highest volume in 10 bars. It's that simple. Why am I doing this? Because a lot of times when you're looking at the histogram, the volume histogram, you will not be able to detect changes in volume unless the volume is spiking up, where it sticks out overtly. And that's how you really miss a lot on the chart. For example, this high volume here was when price went to resistance area. So it's telling you that they're selling resistance. That's why it's clearly saying they're selling, traders are selling resistance. But if you're just looking at the volume histogram, you won't be able to detect it. You won't be able to detect the pressure that's coming in. So what I devised was an alternative, which is labeling, and basically an indicator that explains to you that this is high volume. It won't catch everything that's high volume, but it is pretty good. Developed, actually it should, but relative to the parameters that I put in. Alright, so over here, for example, on the dollar index, you see high volume from a resistance area, from a former resistance area. You know that's it. That you don't really need to go into it more. They're selling resistance, and you decide if you want to jump in or not. It's a low end close, then it has follow through, so on and so forth, and comes back down to a support area. From that support area, it retests, and then guess what? High volume comes in again. Right? High volume comes in again with a high end close on this bar. What is that telling you? It's telling you that after coming back to support, rallying, pulling back on one bar, the buyers are in. Okay? You have follow through also. Buyers are in. Buyers stepped in. And what I like about this thing that I put together is it's telling you this is the highest volume in 10 bars. 10 bars, which basically means the highest volume in the correction. Right? The highest volume in the correction on an up bar means that the correction is very likely over. Why? Because buyers are coming in. That's why. Then finally it breaks out on very big volume. The biggest volume in over 35 bars. That's important information. It's not just high volume or low volume, but it's relative to the number of bars or number of periods or number of days in the background. So this is telling you, hey you, this is the highest volume the last 35 bars. It's the highest volume in over a month. Over almost 2. Say 20 bars is approximately, I don't know, a month, right? It's 20 trading days. So this is 35 bars. It's a breakout on heavy volume. Legit. And it has follow through. This is what you want to see, especially at a former resistance level which was sold. What does that mean? You know what that means? That means that these guys who are selling resistance aren't there anymore. And if they were, they are trapped right now. Either their stops have been run or they're trapped. And when price goes back to this resistance area, they're going to want out. And that will create additional buying pressure, which means basically a very high probability trade. So this is on the dollar index. I was explaining to everybody how in prior videos you watch them, I believe that this was on a springboard. And it was, because look at the base now. This is a pretty big base. Selling, boom, 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 giving you so many trading opportunities. Selling pressure, all over the place, selling pressure. And now the game's changed. The pressure's on the buying side. Yeah? Pressure's on the buying side, and it's taken out resistance. Alright? And in addition to that, you take a look at the euro, which is a chart underneath it. This also explaining to you that, hey, this is legit. It's the biggest volume in over 50 bars that has broken a support area. Okay? Biggest volume in over 50 bars that has broken a support area. So this is how you combine your judgment with the tools, with the factual information. Do not use indicators for buy and sells. Believe me, the market is too smart for indicators. Because of the various ways that price can, because of its range, its volume, there's so many infinite number of ways. It really is not a good thing to just trade mechanically, because markets are notorious for breaking indicators, all indicators. But what you could use an indicator for is to generate factual information. High volume, low volume, relative to X number of bars, or the actual volume print. Is it 1 million shares or 10,000 shares or stuff like that? This is where indicators shine, because a fact is a fact is a fact. Alright? Highest volume in 6 bars. It's a fact. It's very difficult to dispute that. So there's no, you have to be careful whenever there's room for interpretation. The indicators are subject to be clobbered by the market. But when it comes to factual information, they definitely have a place. Anyway, so what was I saying? Alright, so euro is broken, and now it's time to do the point figure counts to see where the dollar is going to go, where the euro is going to go. Okay, so that's the first thing I want to talk about, is this indicator and how it gives information on high volume. The second thing is, after seeing the volume, you will develop a sensitivity to it in the spots that occur. For example, the breakout volume. Oh shit! 1 second. Breakout volume. Second is draw the lines and label the charts. Very, very important to do that in order to build the skill. Alright, I forgot what else I was going to do. Anyway, alright, I'm done. Thanks.